Assalamu alaikum, everybody. Good morning. Thank you for joining our Property Forum seminar today for the British Pakistan Foundation. We are joined today by Colliers, who are helping us on this webinar. Just a bit of background. My name is Adnan Sheikh. I'm a co-founder of South Street Asset Management. We are a UK property manager, developer, investor in various asset classes, residential, office, student housing. And I've been asked today by the BPF to run this webinar with Colliers. Just a few points on the British Pakistan Foundation. We are a platform that aims to engage, unite and empower the more than 1 million British Pakistanis by bringing them together under a single platform to create networks and make a real difference to their working lives and their personal lives. Our focus today is on the Property Forum. We run a number of other forums in politics, legal, medicine, digital services, startups, finance, government and politics. And we hope you find today's seminar useful and networking useful. And we disseminate some interesting information for you for the market that we all work in. As I mentioned at the start of the call, we partnered today with Colliers to organise the webinar. And the webinar today will essentially focus on giving you all a market update on the state of our economy, the financial markets, the commercial property and residential markets, and for everybody to take away some investment considerations. So I'll hand you over to Dominic Amy now at Colliers, who's the head of City Investments, who'll give a brief introduction about Colliers.
Good morning, ladies and gentlemen. My name is Dominic Amy, and my colleague, Dr. Walter Boettcher, and I are very pleased to be presenting to you this morning, and thank you for your time. I've been at Colliers for 18 years, and I head up this City of London investment team at Colliers. So we act for private buyers and families and property companies, pension companies, and even the likes of sovereign wealth funds, overseas sovereign wealth funds, to acquire mainly commercial, mainly offices, development sites, and we also do forward funding and the like. Colliers is a very large listed professional services and investment management company. We operate in 68 countries around the world, and we have 18,000 professionals. We have a revenue of about $3.5 billion US, and we have a huge amount of properties which we also manage. About 33 billion US AUM, so assets under management. So we're a very large property management company, as well as brokerage services. We carry out about 70,000 transactions, lettings, sales, and acquisitions per year. So we're incredibly busy business globally. Next slide, please, Walter. In the UK, we employ about 900 professionals, over 16 offices. We're headquartered in the West End of London, in George Street, West 1. But we have offices, as you can see from the map, throughout the UK in most of the major cities. We advise clients across 6 main property sectors, as you can see there on the top right: office, industrial logistics and retail, hotels, residential and mixed-use properties. But we also advise clients in a lot of specialist sectors that you can see there, bottom right: attractions and venues, tourist attractions, automotive and roadside, data centers and healthcare, licence and leisure, public sector, parks and leisure, waste and energy. So we cover pretty much every property sector that's out there, and within those sectors we then provide specialist services. So from the sort of the usual agency sales and leasing, investment work, which is called capital markets there, and valuation services, but also more specialist services such as business rates advice. We provide debt brokerage as well from our office in Jersey, planning services. We also do bespoke research and forecasting reports for clients as well. So we cover pretty much every sector and every service throughout the UK and globally. There's my contact details, and I'd be delighted to either help you directly or point you in the direction of one of my colleagues should you have any questions or need any assistance with any property related matters. And thank you for listening. I'm now going to hand you over to my colleague Walter.
Thanks, Tom. Very good. But yeah, listen, on the services, the rating guys have never been busier. I tell you what, if you got any properties at all, you should give those guys a ring. It's just, I think they single-handedly have kept us buoyant over the course of the last year, and they're involved in some pretty deep discussions that I think even got the attention of the Chancellor. So there you go. That's the bit for Colliers, as it were. So let's see. So I was speaking to Adnan earlier about the presentation. Look, it's I apologize in advance if it's a little bit dense, but what I'd say to you is that there's a little bit there for everybody in it. And also the narrative that comes through is generally optimistic, and I don't apologize for that. I think that the optimism that I've had for the last 3 or 4 months is finally starting to come good, and I'll show you what that means as we go on. What I want to do is start off with basic economics, and then move into property, and then end up with some observations on what I'd be thinking about as an investor. Well, let's see. So the first thing to say is, well, a lot of people were anticipating a double-dip recession, right? Beginning with a small contraction in Q4 2020, but instead we got about 1% growth, quarter-on-quarter growth, which was a pleasant upside surprise. Of course, not too many people caught that because the main headlines were that we had the deepest contraction in however many hundreds of years it was in 2020 as a whole. Well, listen, forgive me, but that's really old news. That contraction was focused in Q2 of last year, and we always knew that this year was going to be dim. The real news was the fact that things held up a little bit better in Q4 than what people were originally anticipating. The other bit is that the V-shaped recovery that we talked about a lot last year, well, you can see the chart there. We got the first bit of the V, but we've got something looking a bit like a crippled W at the moment, although it's probably flattened out a bit. All the new forecasts aren't yet out and available yet based on the latest GDP figure, but I don't think it's going to change this significantly. Meanwhile, the forward-looking purchasing manager indices, which are a forerunner of GDP typically, are back down substantially below 50 in January, suggesting that Q1 21 is not going to be all, what's the expression, flowers and roses, or however the expression goes. So we got a little bit more pain to come, and that's primarily because we're still technically in what I would consider to be a lockdown. Things are getting good. We're starting to see some real optimism building from a business sentiment perspective. Good numbers coming out of the share indices, and sterling is up to almost 140 last I checked, based on the rollout of the vaccine and the success of hitting our first target. And I think it's a recognition too that the UK has been undervalued for some considerable time, partly because of Brexit. That's sort of behind us, I'll come back to that. And so there's a lot of anticipation that we're going to have a really strong second half of 2021. And I think the Bank of England have bought into this and promoted that idea too, based on what I've told you so far, but also just that building in business confidence. Also, I'd say to you that we got the budget coming up on March 3rd, which is very important. I think there's possibility for further stimulus, and the government has the capacity to do that. I hope they don't scupper their whole plan by getting too deep into taxation at this point, but we'll wait and see. Sunak so far has proven to be a fairly balanced individual. Other thing to say is if we look at the trajectory of recoveries across the main trading segments in the world. You can see the UK comes in last, recovering to its previous pre-pandemic level only by the mid to late 2022. The Eurozone's there in Q1 22. The US is supposedly there later this year. Of course, they're putting a huge fiscal stimulus into the system also. And Ireland, I think that's there for, well, very obscure reasons. One of our key trading partners, they're going to be back out of it pretty quickly. Small economies tend to move much faster than bigger economies. I guess the point from this is that even though we are going to be on a decent trajectory, we're still about 180 billion smaller in terms of economic output on an annual basis, which is a lot of employment if you think about it. And that's the gap that we need to make up. And that will be the thing to watch. Like I said, look for a bit more of government stimulus to keep the workforce in place until we're out of this. The other part of it is that, look, not all parts of the economy were hit evenly. But this chart's, I wish you could have seen the previous ones because it's changed a bit. And you can see that we had in red there at the top, that's basically called it GDP or gross value added of about 1%. And this is where it came from in terms of those parts that were expanding and those were negative. You can see that everything is becoming far more stable now. I think the reason for this is because all the contraction that we're going to do has pretty much been done, right? Having said that, accommodation and food services at the bottom found some way to manage to get even smaller over the course of the last quarter. But it just means to say that we've rebased the economy at a lower level. And now all we really have left is a growth story. And as things come out of as we come out of the pandemic and as the vaccination rollout occurs, then I think you're going to see expansion right across the board in all these sectors. And it's going to be pretty strong. Q2 will be a very strong figure. And by Q3, I think we'll be getting back more, hopefully, to what might be considered trend growth. Just to suggest to you why the headlines are saying that the UK has suffered worse than the rest, there's two things to say. One is that the UK has a much more, we'll put it this way, it's more exposed to services sectors than it is to, say, the industrial production sectors. And this is comparing to financial crises together. And if you look at the numbers long enough, you can convince yourself that this is the case. I'll circulate this at the end so that for those of you that are interested, you can go into it in great depth. But the gist of it is that the UK didn't have much of a industrial exposure, which meant that during the financial crisis, it did okay compared to, say, Germany, which did. But now Germany is doing fine, whereas the UK is struggling. That's the first thing to say. The second thing is I was reading a piece by Capital Economics the other day that suggested that if you do all the growth figures and measure GDP in nominal terms, actually the UK doesn't look so bad. So there's some measurement issues that go into this also that I think it was picked up in the FT this morning, although they didn't explain it. They just stuck a chart up. And so, yes, nothing is quite as it seems. The UK is not in as bad a place as the press sometimes makes out. Of course, one of the sectors that was hit hardest originally, and which is showing decent signs of recovery, is retail. But then again, the question is, what do you mean by retail? You look over on the right here, you can see that the retail sales volume index was up 6.5% year on year. But if you look at the blue, which is non-store based, i.e. call it e-commerce, listen, that's been just storming ahead. And that continues to be a success story. And if the pandemic's done anything, it's turned e-commerce into e-commerce growth into something that's going to be with us for a good number of years before it starts to stabilize at some much higher level of market share. I think market share now is running at somewhere around 28 to 30%. I wouldn't be surprised if that didn't go up a bit further before it stabilizes. And then down below, you've got the store-based sales, which you can see theoretically are coming back to where they were a year ago. How this is computed and how they do is another question, because I can tell you the footfall is definitely not there. It's just to say that most of the sales have gone online and that there's ongoing weakness that is going to remain on the high street for some considerable period. Having said that, I think that consumer spending is going to be the main way out of this. A couple things to say here. On the left is the consumer confidence barometer. You can see it in blue. And you can see how it fell back in February 2020 with the arrival of the pandemic. It hasn't really recovered. It's down to around 2012 levels. On the other side, though, at the top there, I should say in red, is the estimate of savings, household savings, which you can see has gone up and has remained pretty high. On the right-hand side, if you look at that in a little bit more detail, you can see that whereas disposable income growth has been flattish after a bit of a dip in Q2, excess, I guess you should say the savings ratio, the percentage of our disposable income that households save, shot up to a record level of about 28% back in Q2. Well, let's face it, there was no place to go, no way to spend really much money except a bit online, I suppose. It's come back a little bit in Q3. This runs really pretty far behind this data, but by certain estimates, there's well over 100 billion in excess household savings. Now I made this comment in the Midsummer Retail Report back in, when was it? The beginning of December, I think we did it. Midsummer, December, a bit of a delay there. And I think that the reason the press picked up on this figure is because I put it out there myself. So give me a cheer for getting something right for a change, So yeah, but I think that what this means is that over the course of the rest of the year, when the unlocking comes, we could see a pretty significant surge, certainly in those sectors that have been completely closed. So restaurants, accommodation, retail, and all the rest. And I think too that the Bank of England have picked up on this and are suggesting that this is another one of the reasons why they think that the second half of this year could actually be really quite significantly strong. Not least of which because it's not clear that travel restrictions are going to be removed, which means that there's going to be a lot of so-called staycations. I think back in the global financial crisis time, staycations contributed like an additional 5 billion worth of revenues to the UK tourist sector that year. So look for some pretty significant homegrown growth, probably in the early part of the summer. I don't know how rapid that the transportation will return to normal. I suspect that some of our destinations in Europe are going to remain in a certain malaise, probably for a bit longer than us, just because they've had a few more problems getting the vaccine rollout organized and a few other things. The other thing to say is that they make a big noise about the level of public debt. And yeah, we're at about 100% GDP. Of course, the Japanese have been there for years, by the way. So the total debt's somewhere around 2.1 trillion. How does it compare to previous lifts? Well, we got World War I and World War II. So we're probably about half or a third of that. And then there was the Napoleonic War. Goodness knows how they actually measured that. We're about halfway to that, I suppose. So look, yeah, things are elevated. There's no question about it. I think the interesting thing, if you look on the left, you can see that despite debt going up, our interest payments have been falling. In December 2019, in the year to December 2019, our debt was costing us 47 billion a year. In the year to the end of December 2020, despite it going up so much, its interest payments were only 40 billion. It just has to do with low interest rate environment. Matter of fact, the International Monetary Fund have been encouraging governments globally to get out their checkbooks and do some spending and domestic investment and infrastructure and things of this sort to take advantage of these low interest rates. Look, they'll be around for probably another 3 to 5 years, let's say, but they're not going to be around forever. And now is the time to really work that sort of part of the gravy train, if you want to think about it in those terms. But certainly, I think I'm looking forward to hearing the budget on the 3rd, because I think Rishi Sunak's going to be saying something about regional investment. Just a couple of other charts here. This is our debt level in 2021. We're pretty much right in the middle with the US. The Germans are definitely more frugal. The Japanese more profligate. So we're probably internationally, we're not in a particularly bad place. And just to reemphasize the point that our UK government has a certain amount of dry powder in order to support large-scale government investment, particularly this regional rebalancing thing that is at least a year overdue now, which was promised in the Tory manifesto back in 2019. Yeah, you can see in red net debt going up, and you can see in blue the interest payments going down. So, like I say, it's sustainable. I'm really going to be. I put it this way: market in the calendar is probably a key point in the economic year in the UK. I think the budget is something extremely you need to watch. It can be extremely important. I don't know what he's going to do on taxation. I would say that as a property person and with a small portfolio of my own that looks vaguely like a pension plan, that I do worry that they'll be going for fixed assets or wealth that's easy to find, put it that way. So property may be in line. There could be some stuff on inheritance tax and capital gains. I think it's premature. I really hope that he gives it at least another 6 months and then maybe does another budget sometime in the autumn, but we'll just have to wait and see. Okay, so now we get to the interesting part, or at least interesting for me. You know, one of the things that's really struck me over the course of the pandemic, given that it was the largest economic contraction in the last 300 years, I think it was 1707, the Great Freeze or something like this, is that we didn't have the sort of scenario in the global financial crisis where I woke up one day, Monday morning, and realized that the world had almost ended, right, financially speaking. There was a point in March when I think people got a bit twitchy and nervous, which I'll come back to. But after that, the massive stimulus went into the system globally. That seemed to stave off any sort of worst scenario materializing. And we've been pretty stable ever since. And the property markets too, pricing and all the rest of it have moved, don't get me wrong, but it hasn't moved quite as substantially as you might have expected. And I think it all has to do with the global weight of capital, which I give you on this slide here. On the left, you can see that the population is aging globally, but that also means there are people saving more and more for their retirements, which is putting pressure on pension funds to find annuity payouts, right, i.e. a bit of yield and return. And the amount of capital that's accumulated amounts to something like $77 trillion, which are managed by the top 400 institutional funds, that's in blue. On the Capgemini do an annual wealth report suggesting there's at least another 74 trillion in high net worth individuals and family office money. I suspect that their allocations to real estate are pretty similar to the institutional ones. But just to get back to that point, fund allocations to real estate have been increasing, at least since I started tracking in 2014. It's based on the Hodge-Wiles report. Listen, I highly recommend it. It's definitely worth a read. But what it shows is that allocations to real estate have been rising, year on year since 2014, and have cracked 10% a couple of years ago, and are now projected to go up to almost 11% in 2021. This latest little uptick is linked to Asian funds putting more money into real estate. And why are they putting it into real estate? Well, there's just a little bit more return there compared to some of the other asset classes. And I do think too, when a lot of the asset classes have been pretty volatile, real estate tends to be less volatile than some competing investment classes. Only problem is that there's not really enough standing assets in the world to have a ready market to absorb all this capital. And so increasingly, I think we're seeing a lot more institutional investment with joint partners in development. We're seeing that certainly in the UK, and I know that some of the Asian capital, the Japanese, the Singaporeans, and a few others are also looking at these types of investments. Mixed use. We'll come back to that. Just to emphasize the point, this is return versus volatility 2015 to 2020. So you can see the FTSE way over on the right is highly volatile and giving you a return of about an average of, what does it come out to, about 1% per annum or something. Gold's done a bit better, but also a bit volatile. And then you shift all the way over to the left and you can see gilts in the middle, which is meant to be the benchmark for commercial real estate. And you can see generally certain segments of property sector in the UK have done better. Industrial, of course, everybody knows has been very strong. Offices are still in positive territory. And I think residential is interesting. It's giving a decent return, stable return with almost no volatility at all. And I think that's probably one of the things that's underpinning a lot of institutional and cross-border interest in mixed-use residential schemes all up and down the UK, in which I think one of the reasons I'm looking at the budget so carefully is because if this regional investment plan really kicks off like it was meant to last year, and if they start making the announcements about infrastructural investments in the various cities of the across the regions of the UK, I think there's going to be a lot of opportunities to do a lot of interesting things over the course of the next 5 to 10 years. Certainly at Colliers, we've staffed up our build to rent team and our residential team to try to take advantage of that opportunity. But also, just to go back to the simple metrics, you know, I'm showing you on the right here, in blue is the all property UK equivalent yield according to MSCI, aka IPD, and in green is the central London yield. And you can see the differential between that and the 10-year gilt, which is meant to be the benchmark for property pricing, is as big as it's ever been. You know, almost 5% in the case of all property, probably about 3% plus for central London. I think what I'd say to you though is that, you know, what it's saying to me is that there's scope now that we're getting more business certainty, and now that we have an agreed deal with the EU, good or not, and now that we have a decent trajectory on the vaccine rollout and all the rest, I think there's scope for yield compression right across the UK over the course of the next year to bring it in line with some of the other markets. And I gave you this one, which is European prime office yields from the Colliers database for Q4 2020. And you can see that the City of London is at the top at about 4%, and London West End's at 3.75. You know, but look at that. So London West End's 3.75, and so is Barcelona. Listen, nothing against Spain and all the rest of it, but the markets are qualitatively different in terms of what I would understand as prime. You know, and then you go down the list and you can see that there's probably at least 100 basis points of yield to be had for investing in the UK. And this is London prime. We're not even talking the regions where there's probably about another 50, 75 to 100 basis points in a lot of markets. And so I expect to see a lot more activity out in the regions over the course of this year, certainly as the relationship with the EU beds in a bit further and as sentiment starts to build a bit stronger. And if you look at 2020, cross-border investment was pretty much the only game in town. You can see on the left-hand side, they took about a 53% market share of all investment transactions in the UK. 75% for central London, by the way. Why? Because the UK funds were pretty much out of the picture. A lot of them were gating because of redemption pressure. And there were a few sales that came out, but there was not that much acquisition. I think it's starting to change now. I was expecting to see maybe even a little bit of uptick in institutional money in December, but not yet. I think that game will play out now over the course. It's probably already playing out in January, but I think as things warm up over the next month or two, we're going to see a lot more institutional capital in the frame. Certainly, I know some people I know that work in institutional debt told me they've closed a lot of deals that have been laying around for like 6 months or so, and then suddenly in January they all just came to fruition. So there is definitely movement in that particular space. In the meantime, this is pricing. I've looked at yield movements here. In blue is how yields have moved over the course of the last year. So if you look at retail, they've moved out by 77 basis points, suggesting significant falls in value, which is true. You can see in orange is the 3-month change. So you can see even retail, which moved out really quite considerably, has stabilized roughly. Offices also moved out far less, but also stabilized. This is, don't forget, this isn't prime. This is an institutional mix of what I'd call secondary, institutional grade secondary with a bit of prime thrown in. Industrial sector, of course, is seeing yield compression, as is the residential sector. Hotels looks like it's stabilized after a pretty big correction. But look, you know, these sectors, hotel sector, they just closed it, full stop. There was no rental income at all for a while in part of the sector. The fact that it didn't move out further, I think, is actually a testament to the weight of capital that's out there and willing to be patient. I think everybody, certainly cross-border investors, are of the view that Brexit was going to be transitory, which it is, as is COVID, which we hope. Let's not get too comfortable with it. We still got to stay on our guard, I would say. Just to go back to the institutions, this chart on the right shows in blue net retail sales. And you can see that since the funds started to reopen in October, that there's been redemptions. So far since October, something like about 900 billion has gone out, which sounds like a lot. Well, it's significant, but it's not some sort of catastrophic fall. If you look at the blue line on the right, you can see back in the time of the vote to leave, we had some pretty significant outflows in June. And then suddenly we started to have inflows and stabilization by the end of the year. I think exactly the same thing is going to happen here. As a matter of fact, I think that we would have seen after the election, you can see in December 19 there's a little bit of a surge where it turns positive again in blue, because business sentiment really did strengthen on the back of the conservative majority win. Unfortunately, the pandemic came along and stopped that recovery, and that also had repercussions in property, which you can see here. Otherwise, I think we'd be in a very different position. So now the question is what's going to happen when we build sentiment again? What I would say to you is that the speed at which the money came back in to real estate after the vote to leave in 2016 by the end of the year, I think will be matched by the speed that it comes back into property after COVID. Seems to be a little bit more at bay, and that we've got a bit more confidence that it is at bay. So I'd say look for a surge over if not in the next couple of months, then certainly by the second half of the year when things are stable. And that's just going to put more pressure on pricing, along with bringing a bit more competition with the cross-border investors. The other thing to say is that cross-border investors, of course, have been enticed into the UK by the fall in sterling back in 2016. On the left, you can see that we, in the blue line, shows the index value of sterling against all its trading partners. And you can see that it reached a post-global financial crisis high back at the end of 2015. Well, then we had the vote to leave, and now it's been discounted by about 12 to 14% ever since. Things are changing, though, as you know. On the right-hand side, these are forecasts about how far sterling is meant to appreciate over the course of the next 5 years. And these are forecasts that are only a couple of weeks old. Actually, first week of February it was. Excuse me. What does it show you? Well, listen, it's difficult because what this shows is how much it's meant to increase over the average level in 2020 with the average level in 2025. It doesn't really take account of the latest movements at the moment. So what I did is I put in orange, I put where these currencies were based as of 31st December. And you can see that it's like against the dollar over on the right-hand side. They anticipated, the forecast said a 13% rise. But if we're at like 140 at the moment, or I think we were about 135 then maybe that's only a 6% rise. Look, the message from this is that sterling still has a way to go in terms of appreciating back to its long-term international equilibrium level. It's a big debate on what that level actually is. I can tell you with some confidence that it's somewhere between 145 and 160, not a very narrow band. I suspect that probably it's closer to 150 than 145. We'll just have to see how it all plays out over time. But I do think that there is a little bit of currency arbitrage that can still be played. Look, 5% is 5%. And if it takes the edge off of the risk over, say, a 5-year investment horizon, it's something to think about. Just to show you what's happened with speculative trading in sterling, you can see that ever since the vote to leave, mostly speculative positions have gone against sterling. That is, they've been short sterling. You can see the Boris bounce there at around January 20, immediately before the pandemic, and then you can see the pandemic coming in, which sort of blew the wind out of that little picnic. And then you can see the impact of the vaccines rollout, which means that suddenly the market's long again. The fact that the market is so short for so long over such a period, and we're still at around 139 the last I checked, which was yesterday evening thinking about it, suggests to me that when sterling recovers, it tends to recover strong. So I wouldn't be surprised if we don't see a little bit more appreciation in sterling in the short term, in the very short term, as confidence continues to begin. And I do think too that for some time now, there's been a lot of people thinking that UK equity markets look pretty good value. And so I think that we could actually see a lot movement within the share indices also. But look, why is that important? Because, you know, that affects sentiment by business operators, and also has a lot to do with business investment, which has been also extremely negative for a long period. Ever since the vote to leave, businesses have been sitting on their hands, failing to push forward business expansion plans. And so we've been in a bit of a stalemate as far as that aspect of investment, which is crucial to the economy for the last 4 years. Look, I've had enough of this. Nevertheless, I think what's really quite striking is that certainly in the offices sector, as you can see there on the left, rents haven't really moved that much despite COVID and all the rest. Matter of fact, in 3-month on 3-month terms, they're unchanged as of the latest MSCI figures. And over the last year, they're only down by 0.6%. Now, this is average. This is everything. This isn't just prime and all the rest. Meanwhile, you look at retail, and that's really gone down quite significantly. Industrial is up, but the rest are broadly stable. And I think a lot of it has to do with the fact that vacancy hasn't gone up a lot, and that take-up's been actually robust in a couple of individual sectors. Now, I link this part of the occupational market, or all these parts, to business investment. That's why I mentioned it before, because I think when business investment finds its feet, that's going to result in demand for expansion, which is going to result in a demand for space. You know, space that is already in short supply. I'll come back to that point too. Matter of fact, I'll raise it right here. This is a true shocker, this one. I every once in a while you pull up a chart, you pull up some data, you go, no, that can't be right. But look, I've looked at this. I even had somebody else look at it, just to say, I'm not hallucinating here, am I? You know, and this is from the MSCI quarterly index, which shows total development expenditure by all the constituents of that index. So primarily UK institutions and some propcos and likes. It shows total development expenditure in the solid blue line, but it shows real development expenditure, i.e. corrected for inflation, since 2001. And what this shows me is that there was no development cycle ever since the global financial crisis, which has got to be the main thing that's underpinning rental markets across pretty much all of the asset classes, with the exception of retail, which is a whole different story. That's all about structural change in the industry. You know, and we can debate about whether office is going down that route too. Somehow I don't think so, but we can debate that later. Reasons to be. Oh yeah, this is London. A bit more of the take up. So look, in blue we can see that London take up was down by 50% year on year, and yet the rents remain broadly stable. So nobody's moving, but nobody's really exiting the space either, and there's not that much space coming to market. You know, regions, it's a little bit less. And if you look at prime rents, we think those are likely to slip this year and come back next year. The other thing to say, though, in terms of this business investment argument and expansion property needs, I looked at the share indices and updated them and looked at the difference between when we went into the pandemic, or the pandemic impact first became apparent in February 2020 until the recent date. And the curious thing is that pretty much everywhere outside of the UK and Europe has shown pretty reasonable growth in share prices, except in Europe and in the UK, which lags behind. All I can figure is that this had to do with Brexit, because everything else is pretty much the same, I would argue. You know, and having said that, you can see that in where they were in December, in terms of how it compared to the pre-pandemic level, and where they are now in mid-February. So they're moving in the right direction, but there's still a lot of undercapitalized companies just by value. You know, I tried to put some numbers on the left, and I reckon there's about, if the FTSE went up to somewhere like the median point of where all those other indexes are, that'd be a recapitalization of 600 billion. If you look at Euronext over in Europe, and if they moved up to the same level, it'd be another 300 billion. Listen, this is a lot of capitalization. I'm not suggesting this is going to go straight into business investment, but if I were an investor in any of these companies and suddenly it was worth that much more, I think I'd put pressure on management to roll out the business expansion plans and get the thing going. And I think that could actually be really quite instrumental in pushing all markets forward, but especially property markets, and especially property office markets. Just to look at the FTSE 100, you can see how far we fell back when everybody realized that Italy had a problem, you know, and the pandemic began. You can see the big fiscal stimulus that came in, and you can see that it stabilized things at about 30% below, and then it gradually started to grow as unlocking expectations increased. Then we had the second wave concerns where it started to come off, and then the vaccines came along, and it's been a bit of a roller coaster, I suppose. Then you can see where it looks like we're in pretty good territory after the Brexit deal. Nope, new lockdowns. You know, we got to be carried away at Christmas. But now suddenly you see a surge on the right-hand side, and I think this all has to do with the vaccine target being achieved, and just a general sense that the UK was on a pretty decent trajectory, helped by the Bank of England saying pretty much the same thing. I also track the price of gold because it's usually a good indicator of general perception of risk globally. In blue is the daily average, and in orange is the 200-day average. Anything above orange means that we're in a bull market. Anything below means we're in a bear market. If price of gold is going up, it usually means that there's a sense of stress that people are pulling out of equities and pulling out of other asset classes to put their money into what's considered a safe haven. You can see at the moment we're in bear territory. That would be consistent with the sort of optimistic business sentiment story that I've been trying to put across today. But we've been here a little bit before. Let's not get too excited, but it's just to say that things seem to be perhaps moving in the right direction. Now, if we look at property, and again, this slide is meant to kind of encapsulate everything that's going on in UK real estate. It goes back to, I indexed everything to June 2016, which is when we voted to leave the EU. You can see Segro on the top, which is representative of logistics. Well, let's call it e-commerce. That's where they made a lot of their money. And you can see the little hit they took during COVID, but that didn't last very long, did it? And so it's been one big growth story. Now, the mirror image, of course, is on the bottom, New River Retail, perfectly well-run company that's in the supermarkets, which is linked pretty much to discretionary spending and fashion, I guess you could say. And sentiment's definitely moved against that. Now, look, those two bits, I would argue, have less to do with Brexit, less to do with COVID. Well, maybe a little bit more to do with COVID, more to do just with long-term structural change in the industry, which is not going to go away. You know, so I think if you talk to New River, it's all about repositioning assets, even finding alternative use and things of this sort. So there's going to be a lot of opportunities tracking that story going forward as that plays out across the regions. Now, the middle bit gets interesting. First off, we've got the supermarket income REIT, which is the black line there. It's meant to be a dotted line, but it's not. Look, that's completely unfazed. You know, that's a result of non-discretionary spending. You know, you got to have food. If you look at the red, that's Derwent, and you can see the little surge it had back around the election time. Everybody thought we were finally out of it. We're going to get a Brexit deal of some variety. City of London would be back on an even keel and sorted. You know, well, no, COVID came along. That put paid to that little party too. Having said that, it looks like it's back at where it was back in 2016, and I think there's some residual uncertainty left over from Brexit that's unresolved. It has to do with recognizing equivalence and professional certifications and all these sorts of things. I'll come back to that in a minute. But I think a really interesting one too is Granger, which is basically buy to build to rent rentals. again, that's one of those things that you have to have. You have to have a place to live. There's a notorious housing shortage in the UK. And these people are completely unruffled by COVID. All right, it came down a bit, but not long. It was suddenly back up. And even in the absence of or worries about the rental stream for a while, it's actually held up much better. Pretty much all the long income segments are. On the right-hand side, you can see the discount against where we were back before the elections last year or in 2019. SEGRO's up, supermarket REIT, then there's healthcare, residential, offices crept in. Student housing's down a little bit lower, but of course, that's still virtually closed. And I think that'll come back pretty fast too. Listen, the London story, I gotta say a word about this. Look, it's not yet written. Okay, I showed you this slide before showing that take-up was down really quite considerably. Look, the Brexit has been done, but there's negotiations on financial services that are meant to be underway, provided that the EU doesn't lose interest or gets distracted in all the other problems it has. They're talk about regulatory equivalence, and I was reading yesterday in the FT that the UK is about to employ more stringent capital controls than in the EU, which wants to follow a US model, none of which makes sense to me. But what I mean is that, look, you have to read this. I'm not even sure if I completely understand this, but apparently if you invest in IT infrastructure within your bank, you can count the value of that infrastructure as part of the capital buffer. As somebody said, well, yeah, all right, so if you need to draw on that capital buffer, does that mean you sell your IT system? Listen, somebody read it, drop me a note, tell me what it's all about, because it just doesn't make any sense. And the Brits have said, no, we're not going to go down that little road. We don't think that's right. And so there's obviously going to be differences in outlooks, which are going to need to be resolved, and whether they can be or not is another matter. But this mutual recognition of professional qualifications, come on, give me a break. The Brits created most of the legal systems around the world. Why should the lawyers here be any different than lawyers over there? It's governance. Now that's the real issue, isn't it? And I think probably what'll happen is, there were some notes in the paper the other day about how the Euronext exchange in Amsterdam had exceeded the level of the LSD or something for in January, something of this sort. And so there's a big thing about how the EU is actually going to win back all these services. Like I say, it's not going to happen the way people think. The EU does not really have an integrated financial services offer. It's pretty fragmented across about 5 or 6 markets. Look, in time they will, but it's not going to be that rapid. In the meantime, there's going to be a certain dependence on UK capital markets. As a matter of fact, even that share trading in Amsterdam the other day relied on some clearing that was based in London anyway. So it's a really complex picture. I think that lack of an integrated service offer in the EU be suddenly understood a bit more clearly in the next 3 or 4 months, and then perhaps we'll make some progress on coming to a final agreement with the city. The other thing to say about the city, though, last mark, weak sterling over the last few years has attracted a lot of venture capitalism into tech startups, especially fintech, and we're now really starting to see the dividends of that start to pay off. At the same time, London's becoming a virtual tech hub. So look, I'm going to finish off with just a few remarks about what I see as the key indicator to follow. Where should you invest and what should you invest in? Well, look, I tell you to follow the crowd, as it were. And I don't mean the investment crowd, but I mean the real crowd, the real demographics, where the people are, because that's the ones that ultimately create value. I have a chart down below, which I've blown up here. No, I haven't. Where's my chart? Oh, no. Okay, you have to work with this guy. It's a small one. It shows a relationship between working age population growth on the vertical bar and total growth between 2000 and 2015. And you can see there's a pretty solid relationship. Matter of fact, the correlation coefficient is about 0.70 for the techies out there. So if you have a growing working age population, you've got growing GDP and vice versa. If we look at the projections, you can see that the UK is not badly placed, fourth from the right in terms of working age population and general population growth. Matter of fact, the whole Anglosphere looks pretty positive as compared to the Eurozone, which is got negative working age population growth. I think that's driven mostly by Germany. There's life in France and Spain, as you can see, and their GDP figures reflect that too in terms of projected output and all the rest. So the UK is actually not in a bad position internationally. And I think it's not lost on people, and it will continue to attract capital. The other thing to say is that exactly the same concept works on a regional level. This is the UK. And if you're thinking about where to put money in the UK, look, you can't go any wrong following a chart like this. Of course, everybody always wants to be in London, but look, London's a bit of a challenge. It's highly competitive. It's expensive. Sorry, Dob. It's something for the institutions and the cross-border institutions perhaps to fight over. I don't know. But then you get outside, and there's a lot of other opportunity. Manchester has got some pretty significant growth forecast. Bristol, Edinburgh, Birmingham. Now, Sheffield's interesting because if you'd gone back 5 years, this forecast was different. They've taken some pretty concrete actions to try to diversify the local economic base and try to retain students that go through what is a first-rate university at the University of Sheffield. Same with Glasgow and Leeds and places like Liverpool. First-rate universities, but everybody gets their degree and then packs off to London. So I think when I said to you, watch the budget, if the commitment to investment in regional infrastructure starts to come through, and these cities get even more support than what they're already doing for themselves, this is going to be a really interesting game to play. Is that my last slide? Yes, it is. Ladies and gentlemen, thank you very much. Look, I'm happy to answer questions, or if you could disagree with me on things, tell me why. I'd be polite, but I'd be happy to talk about any or all. Thank you very much. Thank you.
Thank you, Walter. That was very informative, very dense, as you said, very detailed. I don't know, Colliers, would your presentation be available to our members if
no problem.
Rotate?
I'll send it around a PDF version after the presentation's over. And listen, just on the follow-up, I know there's a lot to take in. If you've got some burning question or something, drop me a note, and because a lot of them I can answer in like a sentence or two, and it doesn't take very long, and I'm perfectly happy to take those sorts of requests. It comes as the general Colliers service, I guess you could say.
Thanks, Walter. I forgot to mention, Walter, I forgot to mention at the start of the seminar that we do have a Q&A button on the Zoom function where you can fire us some questions. We've got one question, which is, where do we see the future of social housing and healthcare real estate as asset classes heading? I think, Walter, you mentioned healthcare and social housing in one of your slides. I did read in the paper the other day that in terms of what, with key workers, they have essentially been recognized as key workers during this pandemic, but whether we should be accommodating key workers a bit more going down the line in terms of making sure their commute is less stressful. They should be getting to hospitals within 15 minutes. And that kind of blends into this first question about where you see social housing and healthcare real estate assets heading.
Right, listen, this is a big topic. Let's see, where do I even start? Let's see. Let's start with the healthcare component. I used to work in healthcare quite a lot with some of you might know Jeremy Tasker and that bunch of our healthcare team. It's run by Adam Lenton now, and did a lot of GIS work, so I sort of know a few things about it. Yeah, so you go on to say that PHP REIT fared pretty well. I'd say that the primary care part of the equation has been solid all along, and I think it will remain solid. And I think it'll also end up featuring into more mixed-use schemes, especially with relation to social housing, with a mix of social housing, private housing, maybe healthcare, maybe a bit of leisure, maybe a bit of essential retail, convenience shopping, dare I say even office hubs, all combined within the same sorts of projects to sort of adapt to this new structure that seems to be arising and coming out of all the remote working that's been done. I think that's got a long way to play. Now, the healthcare, the only thing that worries about healthcare, and I find it so frustrating, and I'm sure a lot of you that are in the care home element find it frustrating too. You can remember way back in, what was it, 2011? I can't even remember the names of the people involved anymore. We were supposed to have the ultimate solution on how long-term care was going to be funded and all the rest of it. And that was after about 5 years of rubbing chins and hemming and hawing. And here we are like 9 years after that, and there's still no answer.
Correct.
You know, and I think that one of the key things that's been holding up investment, certainly in the elderly part of the population and elderly care and elderly formatted residential units, has been this lack of predictable funding function, or at least knowing what the rules of the game were going to be, so that people could pile in with private capital to set up structures that would complement those, you know, and you know, maybe there's somebody out there and tell me, you know, no, this has all been agreed. I finally,
I think the planning regime needs a bit of an update as well. I think some of the senior living operators out there want to see a bit more recognition in the planning system to get sites through. That's my view on healthcare.
Yeah, I'd agree with that too. So I'd add one other point too. The immigration story, I think, is a bit of a worry. I do note that there's been a lot of, even though the EU residents have stopped coming, if you look at the numbers, Commonwealth immigrants have more than replaced them. That's actually up quite a lot. And I think it's interesting that the Commonwealth migrants tend to have always been more active within the healthcare sector than in, say, construction and things of this sort. I don't know if that's good or bad, but I do know that there's other issues in the sector which have to do with wage levels and things of that sort that needs to be worked on.
Yeah, I mean, obviously our community is well represented in the healthcare sectors and has been working in the NHS since its very existence. So next question we've got is on leisure and travel industry. We're obviously hearing news about, you know, the passports, the vaccination passports and the like, but views on leisure and the travel industry. You know, they've had a tough time. We see Michael Ryan on breakfast news every morning saying airlines are open them up. We see, you know, Wetherspoon CEO saying that, you know, the pubs should be open ASAP. But any views on leisure and travel when we see that opening up? Are we going to see a surge, or is it going to be a gradual?
Well, I'll tell you, I'm thinking about Ireland at the moment. I'm doing some work over there. And originally, if you go back to the summer, last summer, they said, well, look, by the time St. Patrick's Day rolls around in March, we should be back on an even keel. Yeah, well, so that one didn't work out too well, did it? I suspect that this is going to be a little bit slower and a bit more painful than any of us would really want. I think, too, that the travel is going to be very slow to recover. Even business travel, I think, is going to be relatively slow. I have to confess, you know, on a personal level, I don't miss getting up at, you know, 4:30 in the morning and catching a 7 a.m. flight to wherever it happens to be in order to do business, get on a 4 p.m. afternoon flight, come back home and get home for about 9 o'clock. I could really do without that, quite frankly. You know, I think probably that the remote working may actually change the domestic flight arrangements. Having said that, I know there is pressure certainly within the property sector for investors to come and inspect products. They don't like to spend, say, $500 million unless they actually go and kick the tires, so to speak. You know, and so there'll be pressures there too. As far as mass tourism goes, judging by what happened last summer when we unlocked and suddenly nobody went back to work, everybody immediately went on holiday. I suspect that as soon as they make it legally operational and they open it, that people will clamor back to go on those sorts of holidays. You know, so hence I think that the government's probably going to go pretty slow on doing that, because that also precipitated a big surge in infections the last time that happened.
Well,
so
we heard what happened in Dubai after everybody turned up in Dubai, and look what happened in January.
Equally, I think, don't forget too that the EU is well behind in terms of the vaccination program.
Correct. Yeah.
And so I think that's going to postpone the merriment in the Algarve or wherever it's going to be. So yes, there's a bit more pain to come. I can see some discretionary distanced openings for restaurants coming sooner rather than later. Maybe even the pubs, maybe the outdoor pubs. Again, I can remember they all put tents in their back gardens, didn't they? And the game continued. So I wish I had better news for it, but
I think maybe with the testing regime, if they improve the testing regime where we can get quick results, that should improve. I think there's something in the news yesterday about concerts, sports events, where we can get, as long as you've been vaccinated, you pass the quick test at the venue, you're in. This may be one for Dominic, but this is, everybody's asking this question in terms of one from our audience is the retail investment. I mean, let's exclude London from this because we know it's premier, but let's talk about our regional shopping areas, our high streets. Where do we see retail investment in the next 5, 6, 10 years? I mean, we're hearing things about developers having to put a bit of residential into our high streets, more leisure, but aren't we seeing that already? We can't just have kids activities taking over Debenhams. The tent parks, I think, the big Debenham sites, but where do you see retail investment over the next 5, 10 years? Where's it going?
It's a tough one. I'm obviously a London and mainly office expert, but obviously I keep a watch and an interest in the other markets. Clearly retail has suffered, but it was going through a rough time, going back a number of years now, back to 16, 17 is when we started to see issues in the retail sector due to that structural shift that Walter was talking about earlier on. The online sales are increasing hugely to the detriment of the high street. But what you've seen is new concepts and things coming through, and perhaps the revival of some more interesting sort of independent retail shops offering a mix of services. We've seen cafes with barber shops. We've seen all that sort of stuff coming through. So I think that there's no sort of end to people's creativity. So that I think will keep high streets interesting places. But I think we have to be realistic. And certainly when I look at I live in northwest London, and when I look at my high street here, you have a core area, and then you have more peripheral sort of areas on the edges of the high street, where I've seen retail be converted into day nurseries. I've seen retail be converted into funny little business centres where people have split the retail into 4 or 5 or 6 little offices and leasing them out to small businesses. And I've also seen retail be converted into ground floor flats. So I think that there's probably, let's be honest, there's probably too much retail, and a lot of high streets will develop and be centralized into sort of smaller cores, I would have thought. And on the peripheral, we'll see units be changed into alternative uses. At the moment, when it comes to yields on retail, everyone is very suspicious of rental values holding up, and it's very tricky, especially when you've got sort of granular high streets where you might own a shop and then you've got 50 other individuals owning shops all around you, and it only takes a few of those people to feel the strain and lease their units at well below what has been historically the trend for that street or that area, and all of a sudden it sort of sets new rental tones, and you can find your values purely on a rental basis be hit quite hard, and then you combine that with the double hit of sort of yields softening, and your asset values really, people are suffering there.
Yeah, I mean, I was sorry, Dominic. I was reading something yesterday in terms of the discount retailers like Poundstretcher, B&M. You know, they've been doing very well during the pandemic, and you know, over the next few years, they're forecast to do even better. And same in the US. I think there's a South African large kind of bargain retailer that's about to IPO in the market in the next week or two, because they're forecasting further growth in this sector in the UK. So I think they don't. B&M have, for example, done very well over the last 12, 18 months.
And that's a very, very good point. And obviously there are going to be, and there are a lot of operators like that in large units who have really good covenants, where people will look at 10 years to a 5A1 covenant and the yield will be appropriate. Definitely, undoubtedly.
And I think, you know,
I mean, my observation was probably more of a sort of a widespread generalistic view to maybe what properties that are owned by, you know, smaller individual investors.
And some of the large retailers like the furniture guys like DFS, they've actually done quite well during the pandemic. People would have thought that you wouldn't be choosing your furniture online. Well, they've brought some tech into their business and they've done quite well over the last 12 months.
Yeah. They've adapted, as you say, so their units become more sort of storage centers and then deliver from there through their online platforms. I do think that, like everything, it'll you know, there's a long-term story, and you know, people adapt and markets will you know, rebalance and find the new norm.
Dominic, this is one for you in terms of offices. This is your sector. When do you see us all coming back to the office?
Probably a little sooner than we might think. I mean, we're starting to see, you know, some significant leases being signed, and you know, I was really pleased to see you know, the head of Barclays recommit to their offices in Canary Wharf, and they were one of the first people to come out and sort of make statements that people were going to work from home, and so you know, it's a big positive. We've seen a lot of people struggling at home. There are mental health issues. It's impossible to train our graduates when they're sat at home, and you see young people on video conferences sitting in their kitchens. You know, clearly the long term, this is just not the right model at all. I think what will happen is that there's going to be a balance between probably majority working from office, but with a little bit of flex in there for people. You know, on a personal basis, I could see myself, you know, having 4 good days in the office and then a day at home where I have the space to catch up on reports and what have you. I think there'll probably be a more balance, whereas previously, you know, it was 5 long days in the office. So I'm not sure we'll necessarily return to that model, but a lot of people I speak to are pretty desperate to get back into the office, to go and get their coffee from Pretz or wherever it is, and to just have a sort of normal life. The first lockdown in the summer, people sitting in the sun, and it was a bit novel, but this lockdown for everybody is grinding. It's grinding, and so the office is by no means dead. People will be vaccinated, and I think that before long. And one thing I would say is there's been big talks about structural changes in offices. I think that will be potentially a slower thing. In a lot of people's minds, it'll be getting people back in, getting the businesses going, and pushing on with business as quickly as possible. Undoubtedly, there'll be some changes that come out into office designs and M&E, and you touched on it yourself, Adnan, with you know, maybe filtration systems, the ultraviolet systems onto the air conditioning, and better fresh air systems. But that stuff takes a while to come through. I think immediately into the summer we'll see people just, you know, where they can and get back in and just really put their shoulder to the grindstone, as it were. And we've got a lot of catching up to do.
Yeah. One of our members has raised a question on I hope it's correct, the buy-to-let industry. Walter, do you think the government's going to be raiding our buy-to-let investors, landlords, coffers again? They seem to be an easy target. What do you think?
Yeah, it's like I get the impression that if you're a landlord, you're considered to be an evil individual somehow. It's like
Yeah.
you don't actually provide a service. You're just like, well, you know the story. So it's easy to make political points that way. I don't see anything specific to buy-to-let, with the exception perhaps of doing something with capital gains tax and the implications that would run there. I think they've probably done enough at the moment, and it continues to it needs to kind of, I think, see the consequences. Part of it is I saw some figures the other day suggesting that all that's really happened by increasing the cost base of the buy-let operators. They pushed up rents in parts of London and all the rest of it. And
yeah, I mean, if you speak to managing agents, they'll tell you the government shift towards passing on the fee burden to landlords has just meant eventually the market catches up and rents increase. So it's a difficult issue.
I could see something. I can see them doing a little bit with security of tenure. That would be something to watch, I suppose. Although usually they sound out all these things a good 3 to 6 months before they actually do it, just to see what the uproar is going to be. And I haven't heard any big uproars about anything, so I take that to mean that maybe they leave it alone.
We just got one. Thank you, Walter. We just got one question in, which I'll read this one out. There is a shortage of 38,000 nurses in the UK, and as with student private residential boom in the past few years, there is a real opportunity for turnkey housing instead of affordable housing. How nimble do we expect government legislation to be to cover this market need, especially in London, where the housing shortage is well over or circa half a million units short? So I think these questions around, not students here, but nurses. How can we accommodate for them and build for healthcare workers, especially in our big cities?
Well, I'd say at the macro level, I'd say first off, the government, again, like what I said with the healthcare, they need to make the terms and conditions and the regulatory framework 100% transparent, right? Your point about planning, I think, is also an issue too. And even though they seem to make inroads in that, there's still a long way to go. But I think that all this, and I think most of the investment, even in social housing, is increasingly going to come from private investors. There's just not enough money in central government to do everything that needs to be done. And so all I see is seed funding for various projects around the country and enabling structures to allow the locals to structure development projects to make them investable by private investors. I don't mean small private investors, I mean big institutions for that matter too. I think there's stuff going on in York right now. Finally, they're developing that thing next to the train station, and they're having exactly these discussions at the moment. They're very mindful of the social housing and all the implications and the wider sense of social, as in key workers and all the rest of it, but also mindful that they have to make the thing profitable for developers and the local landowners, by the way, and all the rest. And so they're having those discussions now. I'd like to think that the devolution and the new regional mayors that are arising and are finding their feet, I'd say Andy Street's probably different in that he really understands what he's up to. The others, I think, are still...
Andy Street X John Lewis.
Yeah, that's right. He's mayor of the West Midlands. And, when I first met him, I had a chatted with him, I think it was down in Mipham. And he took something, the Paradise in central Birmingham. It was it's pushing around £1 billion worth of projects so far, and it may end up at around 1.8. And it all began with a £50 million grant from central government back in around 2012 or 14 or sometime back then. So I think that the points that you're raising, and I guess my answer to the question is, look, I don't know, but I can tell you the only way it's going to happen is if these new local political structures that are rising, that are designed to try to integrate in the needs of the local community with the needs of the investment community, is absolutely what's going to have to happen. in order to enable any sort of development right up and down the country. And I think that's exactly in the middle of that process.
Okay, thank you, Walter. Dominic, I think this one's for you. How impactful will the trends around well-being and climate change be in refurbishing existing office stock in central London? Are you seeing any queries from developers, end users, occupational tenants, landlords about how they should be adapting now their existing office stock? I mean, I'm working on an office development at the moment, but ours is going to be hopefully built in 4 or 5 years. So I can build in and future-proof into my building. But what about existing landlords of offices? What are you seeing at the moment from occupying tenants, from landlords about how they need to adapt, change their air filtration systems, meeting rooms, density? And kind of intertwined with this question is, how do we see the WeWork and serviced office model? That's all about density, hot desking. I mean, they're obviously having to go through a change. I mean, I know WeWork is offering a lot of concessions, rent concessions to tenants. They're offering professional courses, well-being courses. How do you see that? I'm sure you're being asked this all the time.
Well, if you go into, excuse me, if you go into the City of London at the moment, it's a bit like a ghost town.
Yeah.
So we haven't really lived it much. I mean, there were moments in the summer that I can sort of fall back on to say, and I've seen what our colleagues in the Far East are doing as well. So I mean, on a basic level, people are putting in place things like one-way systems into offices so that you only walk around the office in a certain direction. They're removing every other desk. And you know, you'll see hand sanitizers all over the place, and really and one-way systems on staircases if you've got more than one staircase. And really, that's about as far as you can go when it comes to a lot of people's offices. There was discussion last year about whether it should be mandatory for people to wear masks in the office, and certainly when I go online and talk to people in Hong Kong, and you see them there, they're wearing masks, you know, in their offices. So whether that will become a feature that may help us initially get back to the office, it may well be. Going further than that, you can retrofit your air conditioning systems with UV filters and things, and it's a fairly cost-effective way to do that. You can put that onto existing systems. I've heard of clients doing that, and I think that'd be a good selling point actually when you're doing your leasing campaign. We may also see you know, reintroduction of, you know, amazingly sort of windows that open, or certainly enhanced sort of fresh air systems. And going further beyond that, we were already traveling in the direction of well-being when it came to buildings, and I think that it'll just have an increased momentum really. And so we see, certainly on big office developments, you know, it's very important to have external space, be that terracing. We've seen a lot of, you know, every new development has a roof garden. Buildings now have apps where you're part of a community when you're in a building. So you can join a yoga class on the roof terrace in the summer. You can, you know, have your laundry collected. You could have, you know, you can join classes on mental health and well-being that are part of a building's community, especially when building on larger scales. And I think that, you know, that was the direction that we were going in. It was very important, but I could see that is going to be increasingly important part. And then the obvious stuff, which again, we were already seeing, provision of cycle stores, spacious, probably more spacious shower rooms and things like that. So yes, there will be a change. Serviced offices.
Do you see cars coming back into our cities?
Say again, sorry, Edna.
Do you see cars coming back into our cities? I mean, As developers, we have to replace cars with cycle racks. But with people being a bit afraid on the commutes, etc., do you see more flexibility for local authorities, developers building in basement car parking, or do you see that just as a temporary thing as we move through this pandemic? We should be more comfortable on the trains, etc.
I think that we will not see a return to car parking because high up on the list, and it's even today on the news there was talk about air quality and how it damaging it is to people's long-term health. I just don't think that that's a route that any local authority, council or planning system is going to go down. It's totally against the long-term trend. So we will see the continuation of cycle stores and things like that. Having said that, on a smaller scale, I'd expect there to be, an increase in electric vehicle charging and things like that for little electric vehicles, and even little electric motorbikes and things like that. Certainly, would be in a big scheme, a selling point if you were, providing that sort of facility. A mixture of cycle stores and electric vehicle charging bays, but I don't think. Sorry, Walter.
I had a point. Listen, I think you mentioned ESG agenda. I think we are right on the brink of just this major transformation. We've demonstrated to ourselves that we can do change and do it very rapidly. I think that's been the shocking thing. I speak to my son who's 19 years old. He's stuck at home. He was going to do a gap year. That didn't work out too well, did it? He has a fundamentally different world outlook based on a different understanding of technology and all the rest. And I just see that the sort of developments that we're seeing technologically, whether it's artificial intelligence, whether it's electric cars, whatever it happens to be, we're right at this point now. And we know that Boris Johnson, love him or hate him, wants to push in that direction. I just think that all the stars are aligned for some absolutely transformational experience over the next 10 years. Yeah. And I almost wish I was like 30 years younger, so I had the energy to do it, because I just think it's just this place will not be recognizable in another 15 years' time.
Yeah, I mean, I just wanted to finish off the session today just to kind of touch upon the whole green economy. And I think we've skirted around it just now in terms of electric vehicles are here. Everyone's transforming their vehicles to be electrical powered. But do we have the infrastructure for that? How do we, what opportunities are there for real estate investors in this new emerging, stronger green economy up and down the country? Should we be looking at fuel stations? But fuel stations might be adapting to electrical cars. They might be an excellent way of getting vehicles in. But any views to our audience in terms of who are real estate investors on the green economy, what to be looking out for, what you think is interesting?
Well, we're just releasing a automotive paper today, I believe. It's going to go out. I can't remember what it's called. It's something snappy with a picture of a car with something plugged into it. But they address some of the infrastructure issues there. First of all, we don't have enough electric generating capacity in the UK as a whole to be able to support all of the charging that would need to be done. So there's a major challenge there. Yeah. And then, of course, there is just the actual distribution question of setting up all the different charging posts and the way that technology is going to play too. So it's as long as a piece of string that, there's just loads to do. And I do think, just to go back to the ESG comment, I think that health, well-being, green agenda, all of it is combined into one easy package, ESG, which of course is central to the investment strategy of all the key institutional investors in the country, which are really going to make things happen.
Yeah, I'd certainly, over the last sort of 5 years or so, we've seen, funds with specific, environmental investment strategies. So you can, as an investor, go and find those fund opportunities. And most of the major funds have them, and what they're looking for is properties to invest in that they can turn into very efficient buildings be it through solar or heat exchange or fresh air, but ratings really, to achieve really high ratings. So that will be an increasing area of investment, and certainly if you are embarking on a scheme, then it's something that you should absolutely be thinking about to do and make sure that it is as efficient as possible.
Thank you, Dominic. Thank you, Walter. I think time's up. We're approaching 11:25, 11:30. Thanks to all our audience for all the questions. Walter, Dominic, and Chanel Smart at Colliers, thank you very much for hosting us, for your time and for your input. It's greatly appreciated from our members and from the executive team at BPF. You've supported, this is the second forum that we've done. We look forward to meeting you hopefully in person, or we might do a dual one in another 6-8 months, let's see. And then also a thank you please to Simon Siddiqui and Asif Rangunwala at the BPF, who do tons of work in the background to help us prepare these seminars. And a thank you to both of them. But Walter, Dominic, any closing remarks to our investors, to our audience?
I just want to say thank you for joining us, and thank you for giving us your time.
Thank you.